Hi, I'm Jason Edwards and welcome to Watch Your Six. Today we're going to talk a little bit about some of the indicators or some of the factors that you can utilize to help forecast a market. When you're looking at investing, you want to determine things like the market. Is it going to expand? Is it going to contract? And those are also synonymous with the word bull and bear. You've heard that before. This is a bull market, this is a bear market. Why is that critical? Well, it will let you know what you can sort of forecast as it relates to your potential growth or your potential risk. And that's critical because one of the biggest things that holds people up from investing is not only where to invest, but why. Am I going to lose my money? Am I going to worry about wealth loss? Am I going to be impacted negatively so that I have no capital? We've seen with recent market corrections that the fluctuation in the market can be dramatic. So when you have the ability to sort of get a frame of reference of what we think is going on in the marketplace, it gives you a little bit of confidence when it comes to your investing. So today I want to talk a little bit about how you can use certain indicators to get an idea, again an idea, there's no crystal ball, nothing's guaranteed, but it sort of gives you a forecasting measurement. So to illustrate, let's say you were looking at the manufacturing indicator. And the manufacturing indicator was contracting, it was a little low, it wasn't doing well, we don't see a lot of manufacturing going on. And then we look at the inventory monitors or the inventory indicators to see, is inventory flying off the shelf? Is it doing well? Is it being sold? And we see a slow distribution of inventory. That would give you the idea that the economy is sort of slowing, right? Things aren't being built. And because things aren't being built, no one is really selling those products, which is why things aren't being built. Now, if you flip that and you said, you know what? I look at the inventory indicator and it seems to be that there's a lot of transactions. There's a lot of inventory coming off the shelf. Assets are moving around, which is great. And then you want to determine, okay, is that just a blip? Or is that really something sort of forecasting what we call a wave or a ripple? Well, then we looked at the manufacturing indicator and we see manufacturing ramping up. That means that those entities are actually putting in orders. They're buying stuff, they're requesting stuff, they're trying to restock their shelves. So they are visualizing the potential for expansion or growth. And that would tell you that the economy as a whole is starting to ramp up. Now, why is that example really critical in our sector? Well, as you may or may not know, 70% of the US economy is spent or is built on consumer spending. Recently, our GDP was over 3%. When that GDP was that high, that shows you that you've got the ability or the potential for a very robust, very strong economy. And that's where you start looking at these other indicators, whether it's the CPI, whether it's the manufacturing, whether it's GDP, whether it's the S&P. I mean, there's all indices out there. There's tons of little indicators that can give you guidance. But when you look at them in a sequential order, like I just illustrated, it gives you the potential to determine, is this a good time for me to invest? Is the market got some legs to it, is the term you hear? Is the market going to grow or expand? Now, talking about today's market, 2025, we see a lot of things that are both headwinds and tailwinds. Headwinds, as you can imagine, are something that stop an investment, right? They slow it down. A tailwind is something that pushes the investment forward. So what do we see? Well, in this particular climate, we have geopolitical risks. Those are all over the world. We've got wars in the European area that could always overflow into other countries, and that would create a headwind. We've got a Fed that has not decided to make any adjustments on its Fed funding, which is the amount of interest that you charge when you want to loan money. That could create a headwind. And you've got other areas of concern that could become challenges. The tariff war, if those tariffs do not get resolved, that could create a headwind. But from a tailwind perspective, what do we have? Well, we have a GDP that's starting to grow, right? So that's a good indication. And again, GDP stands for gross domestic product. How much is this country selling and producing? Well, we see the numbers are dramatically higher than a year or two ago when we were -1 or 1. We also have unemployment that is becoming more reasonable and lower. We're seeing inflation starting to stall. That means the cost of goods are starting to stall. Why is that critical? Well, when inflation stalls or starts to retract, the cost of everything you and I buy is going to be less. And that allows us now to spend money and spend it in a way that we feel comfortable. We don't feel like we're strapped. And that's critical because, again, as I alluded earlier, 70% of our economy is based on you, us. spending money. Some other things we see is the amount of money that is sitting on the sidelines. Now, if you look at the money market fund assets, they are highly elevated. That means people have a lot of cash sitting, whether it's in their portfolios, whether it's in their investments, or whether it's in their savings account, not knowing what to do. Well, that creates tremendous opportunity for the economy, because when that cash is there, now we have the ability to flood it with an incredible resource that helps that particular market start to expand. So those are all really good things that we see. We also see that, as I mentioned before, the U.S. labor market has sort of thinned. A couple of years ago, I always told people it was really an employee market. You could go into an employer and there was such a little amount of resources that they were, you as an employee could sort of ask for anything. Now we see the market is sort of balanced out, where now there's not that influx, and now jobs are maybe a little bit more scarce because people have gotten hired. So that is always a good thing for us. We're also seeing what we call capitulation, or the ability to agree to trade agreements. We talked about the EU. That was a major step for the United States when you're talking about trade agreements with the EU. Why is that? Well, we don't have a problem getting European goods here. But if you've ever been to Europe, the US companies have a huge problem getting US goods over there, whether it's automobile manufacturing, whether it's food and supply. So now with the barrier being lowered, you're going to see a tremendous amount of money ramping up when it comes to goods going into Europe. Another thing that the tariffs have done for us economically is it makes it cheaper now to build in the United States. So let's just think about that. It makes it cheaper to manufacture or to build something in the United States, because if it's here, there's no tariff. So if you are BMW, if you're Mercedes-Benz, or you're a pharmaceutical company, or you're a furniture company, and you are building things in Europe, for example, or you're building things in other countries, it becomes cheaper now for you to put your plants in the United States. Now, what's the ripple effect? You hear me talk about that a lot. Well, the ripple effect is now when you have a plant that hires 100, 200, 300 people, and the average salary is $70,000 to $100,000, what does that do to the local economy in that state? Well, that's a huge pop. It also creates an environment where now you've got goods being sold in the United States, and the transport costs are lower, the shipping costs are lower because they're here. So now the cost to us is what? Lower. So those are some of the things that we really do see that are doing really well. Some of the areas that we would caution is when we're looking at the amount of stocks and bonds and the amount of transactions, is we have to really be cautious right now, because when a market is hot, or what we call frothy, there is a propensity for us to just want to invest. We just want to pour it in there, get that money in, get it in, I'm missing out. Now, I agree with the concept of missing out. A lot of times you've heard this term, paralysis by analysis. You're analyzing so much that you really don't understand, and before you know it, you've missed the opportunity. We used this statistic one time. Remember, from 1994 to 2004, the average yield in the market was about 7 to 8%, which isn't bad. But if you missed 10 of the best days in that very lengthy period of time, your rate of return dropped from 7 to 3. So 10 days over 10 years. Can anyone tell us exactly what the best day to invest was in a 10-year period? No, that's impossible. So again, we don't want to miss out on opportunity, but we want to make wise decisions. So I always recommend, and you hear me say this over and over, talk to your financial professional, whoever they are. Get their guidelines, get their direction, get their protocol. Look at exactly how you're structured. Look at what they've done and when it relates to you. Because the opportunities are there, but we just don't want to throw our money into something and not necessarily have the ability for growth. So that's another key component. The other thing to remember when it comes to recoveries and when it comes to any kind of downturn, they're very short-lived. So if you look at all the history and you look at the historical data, for example, in 2020, we had the market correction, right, from February to April. That was only 2 months. Now, the market had a huge dip. Some people went down 15, 20%, but again, it was only 2 months. If you looked at the market then and you look at the market now, you wouldn't even remember it. You'd say, well, that wasn't a big deal. Number wasn't that dramatic. So you really have to have data. You'll hear a lot in these shows. We want to teach you data. We want to make sure you're educated so that when you're investing, you're not driven by compulsory issues, you're not driven by emotions, you're not driven by fear, you're driven by raw facts. And raw facts can really do a good job of protecting us from ourselves, if that makes sense to you. We are sometimes our worst enemy when it comes to investing because we allow those kind of environments to really impact us. If you remember, the 2008 correction we had, I mean, again, that was 18 months, but that correction was a while. But 18 months. No correction has lasted forever, and every correction after, the market has rebounded in a positive way. So a lot of good data that we wanted to share with you, a lot of things that we'll discuss more in our podcast. We hope you're tuning into our podcast at Watch Your Six. We're going to get more into some financial data, more granular. We don't like to do too much on these podcasts because we don't want to bore you. But in consensus, or in summation rather, I'd like you to think about it this way. Look at certain indicators, not emotions, to determine how you think the market or the economy is doing. If those indicators point in a certain direction, then validate that. Talk to your financial professional and say, hey, listen, I've been monitoring some of these particular points. Looks like things are doing really well in this area. I think I should invest. And then get their feedback. And then once you've come up with your plan, execute it. Don't lament. Don't dwell on it, execute it. And don't think, sometimes we throw around numbers, but don't think you're not capable of being successfully financially. Any bit of money can grow. $100 a month, $1,000 a month, $1 million a month, it's all the same. It can grow and it can have a huge impact on your ability to have wealth. So we hope you enjoyed that component. We're going to get a little bit into our DMs today. We're going to talk a little bit more about what our listeners are listening for. And for that, we're going to turn over to our producer and we're going to ask him to give us some of the DMs. We're going to go to our DMs and we're going to try to answer some of those questions. As always, we recommend you to DM us if you want in the social media links, or you can also go to the podcast and send us some messages in the notes below, and we'll try to answer those in upcoming shows. So, Grady, what do you have?
Where should I research to get the best info on AI and tech stocks?
So that's a great question. Because of the buzz nature of AI, it's become the stock to watch. Now, AI is a service. So really what I say when it comes to investing in AI is you got to look at the ancillary. Those are the contributing components to being successful in AI. So what do you need? Well, you need semiconductors, you need wiring, you need energy, right? You need electricity, etc. So when you're researching them, I would tell you maybe go to some of the fund families, some of the companies out there that in the investment world, drill down and look at what their semiconductor positions are. But here's something I would say on all of these investments, and this is critical. Look at the duration. How long has the fund been around? Why is that important? Well, if you have a fund manager that's been around for 15 or 20 years, he or she has been able to withstand market corrections and knows how to pivot. If you get someone that just opened up the latest fund and they call it the AI XX, and you're like, man, this sounds great, but they've only been around a year, 2 years, what do you think the likelihood is there's experience in that manager, or there's experience when it comes to those companies? Same with the companies. AI is a very, relatively new resource, but many of the AI companies, if you look into them, have some legs to them. They've been around a couple of years because they've been in the tech space. So that's what I would do. I would look at investment companies, maybe research their funds, look at their top 10 holdings in those funds. That will sort of give you an idea of some of the companies that are hot. But then if you're going to go with a mutual fund, research the mutual fund. Make sure you know how long that mutual fund's been around, how much, how many years it's been invested. And that could be one barometer. The other barometer, if you're going to individual companies, how long have they been in that space? How long have they been working in that area? So hopefully that'll help you. And good DM, we appreciate that. What's the next one?
Thanks, Jason. This one is from Samir on Instagram. Even if I don't have a lot of money, can I still do a 529 plan for my children?
Any investment can be start with any amount of money. That's a misnomer. People think, well, I don't have enough money to invest. That's not the truth. A 529 is a good example. However, most companies will have a minimum of $100. That's what they'll say for 529s. If you've got multiple kids and you don't have a lot of resources, then just do a 529 on the oldest child first. Invest there. And then what happens is when that oldest child gets older, maybe you can take some of that money and now you can pass it on to the secondary child or the third child. But it concentrates your firepower. It gives you the opportunity to be more successful and have everything in one space. So yeah, the answer is you can do whatever amount you want. If you don't have a loft, just have one 529 and let's get it signed or set up for your oldest child. And then as that older child graduates, there's money left. You can grandfather to the next child and so on. But good question.
Last one here, Jason. This one comes from, it looks like Facebook. My defense companies have been exploding. Should I sell some of them and reallocate that to other areas in my portfolio?
So that is a definition of what we call diversification. So this gentleman or the young lady had a great question. If one of your portfolios is doing really, really well, what you don't want to do is get greedy. And what you also don't want to do is expose all your liability to one risk, right? So if you have a defense position, for example, and you're 100% defense, and you're seeing some incredible growth, it may be a time to rebalance your portfolio and set up your portfolio where you can determine how some of those assets are in another sector that might be protected against a contraction. So if the defense sector all of a sudden stopped and money stopped coming in, you don't want to have 100% of your portfolio in one liability. And that goes for any investment. I don't care how good it is. I don't care how successful it is. Never put all your eggs in one basket, like the old saying says. So yeah, that might be a good time to look at rebalancing. I'd sit down with an investment professional, get their guidance, look at your portfolio position, maybe do some historical background look, back test your theory, and then go from there. But those are great questions. Is that all we got, Grady?
Yep, Jason, thanks so much. We'll see you on the next one.
So thank you again for tuning in to Watch Your Six. We're delighted to have you. Remember, check us out on YouTube, check us out on Instagram, or go to our podcast on Linktree. We like your thoughts and comments. And I'm Jason Edwards with Watch Your Six. See you next week.